The first rates are in. The Nifty is up about 31 points. The Bank Nifty is up about 83.
Now we're up 100 points on the Nifty, while the Sensex has gained 364 points.
It's been almost a daily sort of event for the market, right? Every day the market's been going up and up. In the month of August, we've hardly had a negative day, and it looks like the market wants to conquer 18,000.
Majority of the last half hour odd, we traded closer to around 17,940. Mid-cap index, a little bit of an underperformer today, as was the case with the Nifty Bank.
It was yet another day of gains on Dalal Street, with the Nifty and Sensex gaining for the 7th straight session. This is the longest winning streak in the last 20 months, going back all the way to January 2021. Hello and welcome to this special edition of Bulls Charge Ahead. I'm Anuj, and with me is Rima. Hi, Rima.
Hi, Anuj. So today the Sensex has conquered that 60,000 mark, and we're not far away from the Nifty hitting 18,000, just about 50 points away for the Nifty to hit 18,000 and 3.5 percentage points away from our all-time high levels. So the big question is, after this relentless 2-month rally, we're now close to these, the peak levels. What next? Can we continue to climb higher even after we conquer all-time high levels?
Yeah, that's the big question, right? Is the market ready for life above 18,000? I think 18,000 should happen tomorrow, Rima, unless there's some major catastrophe globally. And of course, all-time high should also happen soon. Look, what's driving this market right now is FOMO, because people have just not realized what happened. We were at 15,500 just a couple of months back, and then I remember at 16,500, a lot of people thought that they were missed out. And after that, the market's rallied another 1,500 points. I think a lot of this pace has happened in August because of the FII buying. The market was doing well even without FII buying in the second half of July. But the real pace has happened after the FIIs have turned all in on the market. Of course, you saw tech stocks rebounding. Consumption stocks did well. Financial stocks have been outperforming. Market breadth has been very strong. So all these factors clearly helping, and the markets got the leadership back in a sense that the consumption and financials outperforming. What that reminds you is of a bit of a deja vu. When the bull market started, this was the pack which really led it, consumption and those who were financing it. After that, of course, IT took over and led the market, but the real rally started with consumption and financials. That space is back. What next? Well, for starters, we are in a parabola, and I think in a parabola, it's really tough to sort of make any kind of predictions or any kind of taking entry calls, because it's always tough, right? A late entry, but the market's not showing any signs of fatigue. For me, I'll keep an eye on the market breadth. That will be the first indicator if this market is tiring out. Just one more point, though, Rima. This is a market which has really, thrown a lot of eggs at a lot of people. Who would have thought, 6 months back that the Nifty would first go to 15,000, and then 2 months back, who would have thought that we'll be back to all-time high pretty soon, or close to all-time high pretty soon. So you don't want to stick your neck out and make another bold prediction, because the market may have a last laugh.
Well, 6 months back, the word was JOMO, joy of missing out, which is very quickly reversed into FOMO. But just putting some numbers on the screen, this market is clearly not afraid of heights. So the Sensex has crossed 60,000 today. The Nifty is just 54 points away from 18,000, while the Nifty Bank is a little more than 500 points away from the level of 40,000. And talking about a melt-up that you were referring to, it's been 7 days on the trot that the markets have closed in the green, and we opened with a gap up. We climbed higher through the course of the trading session and end at the day's high, and this has been the longest winning streak for the market since January of 2011. For the day, the big winners were the Bajaj twins, Bajaj Finserv as well as Bajaj Finance. Hero MotoCorp, HDFC Life has been active and gaining for the last 2 trading sessions, and Bharti perked up today. Also putting some more numbers on the screen. Now, what's the distance from our all-time high levels? For the Nifty, as we said, it's 3.5% away from the all-time high levels. The mid-caps are about 5% away, the mid-cap index. It's the small-cap index which has been trailing. The small-cap index is still 20% away from its market peak levels, while the Nifty Bank is 5.5%. And you were talking about how quickly the markets have reversed. Well, the low was actually exactly 2 months ago. On 17th June, June, the Nifty had made an intraday low of 15,183 exactly 2 months ago, and since then we've recovered close to about 18%. And now I'm going to be watching out for some of the stocks which have not participated or have underperformed the benchmark indices in the last 2 months. Well, one of them is ONGC, and that's obvious because we've seen crude prices, come down significantly. But Reliance Industries has not been a mover. It's just gained about 3% in the last 2 months versus a Nifty return of 17-18%. IT2 has been a laggard, though there has been a significant rebound in the last few days. But names like HCL Tech, TCS is still, in the last 2 months, the return hasn't been matching up to the benchmark indices.
Oh yes. Well, now let's do one thing. We have two special guests joining us now. The market's very close to some really important levels and maybe even all-time highs. Vikas Khemani is the founder of Carnelian Capital Advisors, and Ajay Srivastava, he is the CEO of Dimensions Corporate Finance. Both joining us on the show. Gentlemen, good evening. Thanks a lot for joining us. Ajay, I think last month someone messaged me that he's missed out on the rally, and what to do. The Nifty was at 16,500, and he was waiting to buy at 15,000, and we are at 18,000. Your thoughts on what's taking place right now?
Anuj, you said correctly. Do you have a stock of X to be thrown at commentators or no? Because I think whatever we say, we might have a great chance of egg on our face, because this market has actually moved in a direction which is very different than what most of us anticipated, and it's unabated breadth. And I think it's very clear that it is in a real bull zone of people buying into the market. I don't think we are convinced, by and large, that why it should be at this levels at this point of time, most of the stocks, except certain sectors like power, which are under a great amount of positive bias on the policy front. Those sectors could gain a lot in terms of what's going to happen. But by and large, in a situation of inflation and where we are seeing demand at this point of time, these levels would warrant caution, because now you're buying a P expansion. You're not buying really a value in terms of the market is down and so on. So, but having said that, on an intersection of greed and fear, you can decide where you are. But if you are well invested, I think it's a good time to hold your hand, then put more money into this market and wait it out. But as I said, some sectors still give you opportunities like power. In our case, that's the biggest one in this country, which is going to gain what's happening in the government. So pick and choose carefully. I think consumption stocks will take a beating because inflation will kill them. But eventually demand supply may overrule. But finally, rules of economics tell us that I think we have an overheated market. And more important, Anuj, we've got maybe about 70 issues coming in the market. So even if you have powder dry on the side, there is enough new paper coming to help you get a decent return. So don't worry about missing out. A lot of new stuff has also come to the market, the IPOs in the market in the next 3 months. So you'll have enough place to deploy the money, even if it's not in the secondary market.
Oh, absolutely, Ajay. And actually, I was including myself in that list when I said, the market's thrown a lot of eggs, and actually I was putting myself right at the start of that line. But Vikas Khemani is also with us. Vikas, good evening to you. You've seen many market cycles. What explains this? Just 2 months back, the market was just worried about inflation, recession, rate hikes. And, it's not that those fears have gone away. Some may have gone away, maybe on inflation. The market's moved to almost all-time high, and it's moved there in a matter of 1.5 months.
I think so. This is how markets do function, right? If you just go back to the psychology between May and June, I think there was extreme amount of pessimism driven by the high inflationary pressures, and thereby resulting any interest rate increase and liquidity related issues, right? But if you see in last 2 months, we have seen most commodity prices correcting between 20-25%. So it is all about inflation and inflationary expectation. So as the commodity prices are coming down, which was the biggest source of inflation, inflationary expectations have started taming off. So when the peak pessimism was there, markets of course took a toll. And as these factors do sort of settle down, commodity prices started coming down, oil prices came down, which is I think biggest worry for India, and of course globally. We saw a bit of risk appetite coming back. So it always starts with a short covering and then risk appetite coming back. So I do believe that those are always a great opportunity in the market because and I think in our previous interaction, we've always discussed that these are going to be temporary and short-lived as long as the long-term India story is sort of intact. And we all, sort of knew in that sense that, these commodity prices could not sustain and would not sustain at these levels because they were unsustainable, they were temporary because of the conflict and a lot of other issues. And now I think, we have had a pullback rally. Now, how long it sustains really depends on, a lot of other factors, including what pace of QE is adopted by the Fed, and thereby impact on the growth. Definitely, growth in the developed market will be questioned, but in India, I don't think there is, in my opinion, any challenge on the growth side. India's story has lots of pillars, lots of legs of growth. Biggest one being additional ones being coming from manufacturing side, which is providing impetus. Local consumption is strong. Local investment cycle has picked up in a big way. So I continue to believe that nothing has kind of derailed in terms of long-term India story. We had a one quarter pain, which I think will go behind. And I think if you see most quarterly earnings of the companies, I don't think there has been any kind of disappointment. In fact, most companies have reported good numbers. That goes on to say that India's world's global problems are not India's big problem. Of course, when global slowdown happens, there can be some impact on that. I think we will be the amounts of growth, the West market in terms of stability from all fronts. So I think that remains intact.
Gentlemen, evening. This is Rima here. Vikas got you in a bit of a scratchy line. Ajay, you spoke about PE expansion. India was never cheap to begin with, and now with this rally to 18,000, we've become all the more expensive, especially relative to the rest of the emerging markets. What could be the extent of PE expansion from here on?
I think it's all going to be all about PE expansion, Rima, because the earning expansion, if you look at this, even the RBI says that the economy will not grow beyond 4.5%, 5% in the next 2 quarters. So therefore, the earning expansion can at best come from cutback commodity prices a little bit, which are also stabilized now, and maybe cutback in expenditure on advertising and publicity, which is, I believe, is being heavily chopped by most companies because either they have the demand like auto companies or consumer companies trying to find the balance. So I think it's going to be all about PE expansion. And that is why when I said greed and fear is the fact that now what you're buying in the market, and doesn't matter which segment you are, now you're buying a pure PE expansion play and a pure demand and supply play. You're not playing on fundamentals anymore because everything is 40, 50% above what is being 2 months back or a month and a half back, and they've covered up quite a bit of ground. And even on the earnings side, I may tend to feel optimistic about India's growth prospect. But given the perspective that we are still going to be below 5 to 6% in the next 2 quarters, there is only so much you can grow. And the last point is that, we still haven't seen an economic policy come with a little delay. The interest costs now building up into the EMIs and personal loans will start to hurt people, not immediately, but in the next 2 to 3 months. And where is all the loans going? Personal loans. If you look at the banks, fintechs, finance, NBFCs, everybody is now lending to personal loans where interest rates are going higher and will become very soon unsustainable by a large measure. So I think you as an investor, as I said very clearly, now you're not buying in terms of whether earning expansion, except maybe a few companies will have it. And you see in sector like multiplex, etc., which reached a good point, have corrected and will correct now again, because whether we like it or not, inflation will cut consumption, and therefore the big growth of financial sector coming from personal loans, I think will slow down and will face stress. Maybe not today. It'll take 6 months for it to come, but it is inevitable. That's the impact on inflation. So, so I can't, that's what I said, only one sector I see which has got a little bit of traction, which I see, as I said to you, power sector in the whole economy. That is because of the policy decision which are going to come for the sector. Apart from that, everything else, I think you are now really buying serious PE expansion, and nothing is cheap. Everything in this country, P's of 30s have become the norm, 40s have become the norm. Growth is 5%, P is 40%. You can pick and choose why you're buying the stock.
Vikas, Ajay finds the power sector the only attractive space in the market. And with the markets at these levels, you have to be very careful about stock selection. What is it that you would back at current levels where you see value?
I have a slightly completely different view. I think I think today
Vikas,
what's
we'll
happening
try.
in the banking.
Sorry, Vikas, we'll have to redial you. This, as Rima said, we have you on a bit of a scratchy line, so we'll come back and dial you again. Let's do one thing. Let's take a break. We'll do one thing. We'll, of course, take a break. We'll come back. Perhaps have that line back with Vikas. As we do that, let's hear out some opinion that we got through the day.
Most of these commodity inflation sort of tapering off, there is an expectation that as we head into the next few quarters, let's say third and fourth quarter, it will, things should be better off from the profitability front for the companies. Plus, the ensuing festival season should also uplift some bit of the demand momentum. So I think all in all, that has got factored into the markets level today. And the way to sort of think maybe from the levels perspective, I mean, there's no point in sort of predicting these levels, as we generally get caught on the wrong sides most times. But I think more importantly, the fundamentals seems pretty good right now. Real estate is doing well. We saw the order book position of a lot of these engineering and capital good companies. I think they are at their all-time highs today, which is also a signal of a lot of activities which are happening and sort of likely to benefit these companies. So I think some of the larger segments, and banking, one of the largest, is actually started showing good credit growth. So all in all, I would say things are being on a cyclical upswing, which bodes well for the long-term outlook of the markets.